This is another episode on the Henry Warren webinar series. Today we're going to be talking about Business Valuations 101, so a high-level look at business valuations. The panelists today are myself, Brock McDonald. I'm a CPA, CBV Senior Manager here at Henry Warren. Work on the accounting side and then also help manage and run the valuation practice here at Henry Warren. And my colleague Celine will tell you a little bit about herself.
Thanks, Brock. Hi, everyone. My name is Celine. I'm a CPA CA, currently working as a senior assurance manager at Henry Warren. I'm in the process of obtaining my CBV designation. It's a pleasure to be presenting to you today. I do have a bit of a cough occasionally, so please bear with me.
Great, thanks, Celine. So we'll get started. As I mentioned, we're talking about Business Valuations 101. So some of the things that we're going to, first a disclaimer. Today we're going to be talking about general valuation concepts, and every situation is specific and different. So if you are going through a business valuation or looking to have a business valuation, we highly recommend that you reach out to your advisors, your accountants, your lawyers, and get advice from them for your specific situation. The things we're going to look at today, the what and when of business valuation. So what is a business valuation in general? When might you need a business valuation? The different types of reports that are issued under the CICBV standards for business valuations, the different approaches and methods to valuing a business. Then we'll take a look at some other valuation considerations. So some things to think about if you are going through a valuation exercise, why business valuations are important in today's landscape, and then we'll open the floor to any questions. So if you do have any questions throughout the presentation, we'll address them at the end, and you ask those through the Q&A function of Zoom. So first thing, what is a business valuation? So a business valuation in its simplest form is really an estimate of what the company is worth. When we're doing business valuations, we're doing them under the CICBV standards. So that's the institute that kind of mandates and business valuations in Canada. And so under the CICBV standards, we're looking to come up with the fair market value. There's a few different definitions out there of fair market value. I know IFRS has one, which is an accounting standard, but we're always following the definition specifically under the CICBV standards for evaluators, which is the highest price paid in an open and unrestricted market between two informed and prudent parties acting at arm's length, neither under any compulsion to act, expressed in terms of cash. So a lot of words there. But in essence, what it's saying is the highest price in a notional context where all other things are equal, expressed in terms of cash by two unrelated individuals. So when might you need a business valuation? There's lots of circumstances that give rise to when you might need a business valuation. So we have a list of a few of them here that I'm going to walk through, but it's by no means an exhaustive list. So when you're selling or purchasing a business, you may look to get what is the notional value of this business, what is the intrinsic value, and how does that relate to how much I'm receiving from my business, the offers I'm receiving, or how much I'm willing to pay for a business. You know, is it a discount? Is it a premium, etc.? We'll talk a little bit later why there might be a discount or a premium. Raising capital. So you're looking to get some new investors into your business. They'll often take back some preferred shares or some sort of compensation. They'll want to know that what they're taking back is adequate to what they're putting in and what the business is worth. Restructuring ownership. So this could be as simple as Celine and I own a business together and we want to change the ownership percentage and we want to do it fairly under the valuation. Or maybe succession planning. So you're looking to retire and you want to transition your business to a key employee or to some family members, and you want to know what it's worth, or you need some support for CRA or tax purposes if you are doing a family transaction there. And the last reason here is family law or litigation. So this could be divorce proceedings. One of the spouses owns a business. You need to know what it's valued at in order to segregate the assets. or business litigation. Somebody is suing another company, there's land being expropriated, so there's business losses or there's a patent infringement. And so valuation is often considered there as well. So next, we're going to take a look at the different types of business valuation reports. So under the CICPB standards, when you're issuing a value of a business and you're opining on value, you can't just verbally express what that value is. It has to come along with a, certain report that is mandated under them. And so there's three different levels of reports. There's the comprehensive report, the estimate report, and the calculation report. Each of these reports come with varying levels of investigation and assurance and costs. And so we'll briefly take a look at kind of what the differences are of those reports. So the first report we're looking at is the comprehensive valuation report. And as it says in the title, this is the most comprehensive dive into the factors affecting the valuation. So you're taking a deeper look into the economy and the industry and these external factors that are affecting the business value and the business operations. You're trying to corroborate a little bit more on what the owner or manager might say from your interviews. And so you're taking a deeper dive and you're putting more detail in the report. And so the report would be longer, it would have more factors in there. And with that, obviously, comes more time and a higher cost. However, it has the highest level detail and assurance. This type of report is the least issued valuation report, not only by us, but by CBVs in general, because it's commonly only used for litigation and family law purposes. So basically, if you're going into the courts, this is often a report that will be used because it's of the most detail and the most assurance. The next report is an estimate valuation report. So this is kind of what we would refer to as the mid-level report. So it's based on a more limited review and corroboration of the industry information, a little bit of a less dive into the economy and really just less detail of that in the report. It still has more due diligence and assurance than the next report we're going to talk about, the calculation report, but obviously not as much as the comprehensive. And therefore it comes kind of with a mid cost between the calculation report and the comprehensive report. It's often used in transactions where the parties want a little bit more assurance in the calculation report. They're willing to pay a little bit more, but they really don't want to pay the full price of the comprehensive report. And the last report is the calculation valuation report. And so again, this is the lowest level of assurance, but this is by far the most commonly issued valuation report by CBVs. It technically says it's based on a minimal review and analysis and little or no corroboration of industry or client provided information. Now, I want to note that, we are still considering when we do this type of report, we're considering economic factors, rates applicable at the time of the valuation, how the industry fares. We are considering these factors just in less detail, and there's a lot less of that detail within the report. This would be the most cost-effective report, but provide the lowest level of assurance, of course. And so this report is commonly used to establish preliminary value when you're looking to sell or buy a business, or when you're restructuring or doing tax planning. So a lot of the time, these are the types of reports that are issued as support for tax reorganizations if the CRA were to come looking for some support there. I do want to note before I move on that although these are three different reports at three different varying levels of assurance, it's not to say that the value wouldn't come out the same in each report. It's just the level of detail within the report and how far into the weeds you're going on the external factors. So that's it for the report. So I'll hand it over to Celine to talk a little bit about the different valuation approaches.
Thank you, Brock. There are three approaches to evaluating a company, and the approach that is used really depends on the circumstances of the company being valued. Next slide, please. First up, we have the market-based approach, which can only really be used if comparable company data is readily available. For example, under the public company method, we would need to collect data on comparable companies active in the stock market, use the average value and earnings multiple of those comparable companies as the basis for the valuation. Similarly, under the comparable transactions method, we would be looking at historical purchases and sales of similar companies and their values and earnings multiples to build the valuation basis for valuing the current company. The market-based approach aren't really used for private company valuations because of the lack of information available for comparison. And so um, typically for a calculation report, rarely do we see market-based approach. But that being said, earnings multiples that are prevalently known in the industry could be used as a secondary method to sort of double check whether the primary approach used is calculating a value that's within the range.
Definitely.
Next slide, please. Next up, we have the asset-based approach. These methods are used for companies without commercial operations, and so their value would be dependent on the assets that are within the company. The distinction between adjusted net book value method and the liquidation method is really dependent on is the company a going concern, meaning that will the company continue to exist or will there be a forced sale? If there is going to be a forced sale, then we would use the liquidation method, and the value would then be calculated based on the after-tax cash retained from selling the assets and settling all liabilities. If the company will continue to exist, then value will be calculated using the adjusted net book value method. We would be using the shareholders' equity as a starting point, and then any fair market value differences would then be adjusted for. As an example, holding companies typically own real estate and portfolio investments, and the value of those assets would have changed since their original purchase. That's what we want. We want their value to go up as an investment. And so we would account for those fluctuations, as well as the expected tax impacts due to the change in the value of those assets. One thing to note is that if the company owns real property, we do require a separate real estate appraisal to be provided to us. We don't value the real estate property held as part of the valuation.
Yeah, and so, if we are asking for a real estate appraisal, we do have usually appraisers that we can recommend as well. And I would just add that, similar to the market approach that Celine talked about, this is sometimes used as kind of a secondary approach to a reasonability check. If we are doing a cash flow based approach, which Celine's going to talk about next, we'll still do an asset based valuation as well, typically just to see how much goodwill, the commercial goodwill there is in the company, to see if that calculation is coming out reasonably.
Absolutely. Um, and so, as Barak mentioned, there's finally the cash flow based approaches, which is most common because it's used for companies with operations that generates cash flow, and most companies requiring valuations are or do have commercial operations. I'll talk about the two methods briefly and then in more detail with some formula visuals. The choice between the two methods depends on the stability of the company's financial performance. And so if we can predict the future expected cash flows based on historical income statements, then we would use capitalized cash flow method. If we expect for there to be significant fluctuations in the expected future cash flows, then we would want a forecast in order to have more accurate data and present value the forecast back to the valuation date to calculate the value. Next slide, please. This is the formula for the capitalized cash flow method. We start off with the maintainable cash flows, which is typically derived from a review of about 5 years worth of historical income statement data. Then we normalize the before tax operating income for items that are not core to the operations, like discretionary expenses or underpaid expenses. So as an example, salaries paid to the owner Is that at fair market value? We would account for that. Then we would deduct income taxes and annual purchase of capital assets required to estimate the maintainable after-tax cash flows. We would then multiply it by the capitalization rate, which in other words is the expected rate of return by reviewing the risk-free rate, industry, company, and borrowing risks. Oftentimes, an operating company can have portfolio investments or have purchased real estate as well and taken on mortgages as a result. Those purchases or assets and liabilities aren't really core to the operations, and so they would be added or subtracted from the value generated from cash flows. And as a last step, we would subtract any debt repayable from the value that was just calculated to derive the final on-block fair market value of the company. Next slide, please. With the discounted cash flow method, cash flow is generated in two parts. The first part is when there's a period of fluctuation, when things aren't as stable, and then stability happens, growth plateaus. We would need a forecast of both and consider, again, any normalization adjustments, capital investments, or working capital requirements. Present value those cash flows back to the valuation date to calculate the bulk of the value. And then we would also consider if there were any redundant assets or liabilities in the company and subtract out any debt outstanding in order to arrive at the final value of the company.
Yeah, that's great. And so I just wanted to touch on the forecast that's provided. Technically, as the valuator, we can't come up with the forecast. We can't develop it because it creates an independence issue there. So the client or the management or the owner has to create that forecast, and hopefully they kind of already do that as their process. And if not, they would come up with one. And then we would vet it still for reasonability based on external factors, the industry, historic results, etc. So, excuse me. So now that we've taken a look at some of the approaches, thanks for that, Celine, we're going to talk about some of the items that might come up in discussions between the client and the valuator when going through the valuation exercise. Some of this Celine already alluded to. So the biggest conversation or the most common conversation is about the owner manager market salary. So when you own a private company, you can decide how you're going to remunerate yourself. You can take no salary or dividends and, put the time in and bank on banking out later, or you can pay yourself via salary or dividends. Salary comes out of the bottom line of a company, comes out of the net income. Dividends does not come out of the net income, comes directly out of retained earnings. When we're deriving the maintainable cash flows that Celine talked about, we're typically starting with net income. And so if a owner has only taken dividends in the past, there's going to be no consideration for the market salary of what they're putting into the company. Similarly, they might have under or overpaid themselves. And so that's why we're often trying to come up with what is the market rate for the role the owner is doing if they're a hands-on owner and they're partly inside the management group, and their responsibilities. And so this is often a hard question for the client to answer. It's hard for anyone to kind of put a value on themselves. And so we'll often ask questions like, if you went to Costa Rica for 2 years on a vacation and wanted to be hands off of this company and have someone come in and do your role in the company, how much would you pay them? What would be the market of that? Or if you were to leave and go work for a competitor with no ownership, just as a salaried employee, how much would you want to be paid? So we'll kind of ask those questions, get a sense, and then we'll look also at, market rates based on surveys and other industry data that's available online or through databases. The next question, similarly, we're trying to get a market rent. So, a company may be paying rent to a related party. So the owner might also own the building, or they might have too much space or not enough space. So is it ideal? And is it the market rate for what you need in this company? And so that's often an adjustment as well if the company is paying rent. The next one is we're looking at any other discretionary items. So Celine had alluded to removing these because we're looking at it in a notional context. If someone were to come in and buy this business and run it as lean as they could to get the most efficient cash flows out, what would be the rates they'd be paying? What could they cut out? What would they have to add? And so these discretionary expenses, some examples are often like meals and entertainment or donations. So meals and entertainment, cents tickets are nice to have, but are they a need to have? If you got rid of the cents tickets, would you still have the same client base? Would you still achieve the same top line revenue? Same with donations, very nice gesture to give donations. And in some cases, they might be required for the business, depending on who your clients are. Whereas in other cases, they may be able to be cut back and still maintain that top line cash flow. The next 2 points are kind of talking about what Selena alluded to with what we call redundant assets. And so, she had talked about some real estate or short-term investments. So these are the types of assets that you could remove out of a company and still maintain the same operational cash flow. Vacant land is another good example. And the last one is excess cash or working capital, right? So how much cash or working capital is required to operate this business? Over time, a company might accumulate a lot of cash without paying it out. You might be able to remove some of that cash out of the company and distribute it to the shareholders or elsewhere, without actually affecting the operations of the company. So that's another thing that we talk about and look at, right? How much working capital do you need? What are your costs? How much do you need to float moving forward based on your collections and your payment schedules, etc. Of course, there's a lot more discussion points than this. I just wanted to give some examples of kind of some of the questions you could expect when meeting with an evaluator during the process. So just wanted to touch on a few other valuation considerations. So these are some considerations when doing evaluation under the standards. So the first one being hindsight. So technically under the standards, hindsight is not allowed. And so, for example, a business valuation is always at a point in time, one date in time. And so, for example, if the valuation was December 31st, 2023, and we're now in August 2024, maybe at 2023, we expected the revenue for the year was going to be $1 million, and now it's a lot lower. Technically, we have to go based on the rates and assumptions that were available at the valuation date. And so, although it might seem most appropriate to use the most recent results, really we have to do it based on that valuation date. And so that's what this is referring to. That hindsight is not allowed under the standards. The second one here is special interest purchaser. So I had alluded to earlier in the presentation about possibly some reasons why price and value might be different. And so there's a lot of different reasons for that. One might even be just negotiation skills between the two parties. Another is a special interest purchaser. So this is someone that's willing to pay a premium on top of the value to achieve some synergies. So, I'm buying a business and I'm a competitor and I already have some economies of scale of buying the supplies that business needs, or I have my own accounting department. I'll be able to save costs by cutting some costs there. That means the cash flow I'm going to achieve by making this purchase is maybe higher than another buyer might achieve. And so I'd be willing to pay a premium for that. That's what's considered a special interest purchaser. And the last one is a minority discount. And so that's to say that when we're doing a value, we're valuing the en bloc value of all the equity of the company, as Selena talked about. And so that doesn't necessarily mean that you cut the pie evenly when you're actually valuing the individual shares. So if Selena and I own a company and I own 10% and she owns 90% and the total value is $1 million, doesn't necessarily mean that my value is going to be 100,000. If I only have 10% and I don't have votes, maybe I don't have any control over the company, right? And so she's able to make the decisions about the company. She has control about the company. I'm going to want to pay a discount there, not having control. And so I'd have a little bit of a discount on the value, and she may even pay a premium for control in that situation. So lastly, we just wanted to talk a little bit about why it's not only important to get business valuations in today's landscape, but why we're seeing more and more of a need for them and increase in the number of them. So the first point, CRA seems to be cracking down with more scrutiny and doing more investigation. they've come out with certain tax transactions where evaluation is required as support. And so that's a reason why we're probably seeing a lot more of them and why it's a good idea to have one as support, especially in a transaction that's non-arm's length, so between two related individuals. And the next 2 points kind of go hand in hand, but there's an ongoing shift in generational wealth in this country. The aging population is contributing to that. It's no surprise that the population is aging, and as part of that, a lot of the entrepreneurs and owner managers are retiring, and they're looking for someone to hand the business over to. They're looking to transition it to a key employee. They're looking to transition it to their children or whoever it may be. And so that's also giving rise to a lot of valuations, especially like I mentioned for non-arm's length. So that's what we have today. So I'd like to open the floor to any questions here before we wrap it up. So I'll just take a look in the chat to see if we have any questions, or sorry, in the Q&A function here. Okay, we have one question here. So the question is, how far in advance should I get a business valuation if I plan to sell my business? What are some first steps? Okay, so not a loaded question, but I'd say I'm going to give, the classic kind of generic boilerplate answer here of it depends on the specific situation. But it might be worth it sometimes to get a business valuation a couple years or a few years in advance of when you actually plan to sell the business. The reason for this is sometimes there's some planning opportunities to have some tax savings. And so, you would have to talk to your tax advisor first, but there's sometimes asset tests on how many assets are active versus passive. And so some of that is considered goodwill would be considered an active asset. And so as with the valuation, you might be able to come up with those numbers or do some planning in order to get to that spot you want to be to get the tax savings. So I'm not going to get too into the weeds of the tax there, but it really depends. So if you are looking to sell your business, I think that the first steps are really to meet with your advisor, your accountant, and specifically your tax advisor to see if they think that a valuation is warranted right now, what the options are on selling the business, and because there's multiple ways to do that transaction. And then go from there. You might want to do a valuation and then update it again later at the transaction date, or you might be in a situation to wait closer to the sale date. So those I would say would be kind of the first steps to reach out to them. If you are looking to sell your business, we do have another webinar called I'm selling my business, what next? So you might want to check that out. I don't see any other questions. There was a question if it'll be up on YouTube. Yes, it will be on YouTube. That kind of goes into my next point. If you want to follow us on LinkedIn to stay in the know, you'll see any upcoming webinars that we're going to put on. And also to subscribe to our YouTube channel where you can watch some of those previous webinars, like the I'm going to sell my business one, for example. So that's all we have for today. So I hope you enjoyed it, and I hope you tune into our future webinars. Have a great day.
Thanks, everyone.